Let's talk about Elevance Health, a major player in U.S. healthcare whose stock has quietly dropped below the radar. At Insightful Value, we highlight strong companies trading at surprising discounts, and Elevance might just fit that bill. So what's going on here? Is the market overreacting, or are there real issues under the hood? This review is for informational and educational purposes only, not financial advice. If you find value in these no-nonsense breakdowns, be sure to like the video and subscribe to the channel. Elevance Health, formerly known as Anthem, is one of the largest health insurance companies in the United States. It provides medical, dental, vision, life, and disability benefits to over 47 million people. It operates under a range of regional brands, many of which carry the Blue Cross and Blue Shield name. The company generates the bulk of its revenue from its commercial and government healthcare plans, particularly Medicaid and Medicare Advantage. So why is the stock down? Over the past several months, Elevance's share price has slid, despite solid revenues and steady earnings. The pressure mainly comes from rising medical costs and uncertainty around healthcare policy. Like other insurers, Elevance has seen an increase in medical utilization post-pandemic, especially for outpatient services, which cuts into margins. There's also concern over changes in Medicaid redeterminations, which have caused some churn in membership. Yet, financially, the business is still performing. Elevance recently reported quarterly revenue of over $43 billion and net income of around $2.3 billion. Their operating margin sits near 4.5%, which is healthy for a large insurer. Return on equity is strong, and the balance sheet is solid with manageable debt. Even with the challenges, the company reaffirmed its full-year outlook. From a value perspective, Elevance is now trading at a price-to-earnings ratio that's significantly lower than its 5-year average. That discount might reflect short-term noise more than long-term fundamentals. The stock now yields about 1.4% in dividends, and those dividends have grown steadily year after year. In fact, Elevance has more than doubled its dividend over the last 5 years, while also returning capital through buybacks. So, what are the risks? First, healthcare costs are volatile, and unexpected spikes can seriously affect profitability. Government policy is another wild card, especially around reimbursement rates and Medicaid eligibility rules. There's also competitive pressure from other major insurers and newer tech-driven healthcare providers trying to eat into market share. But the case for Elevance remains compelling. The company is well diversified across states and insurance types, continues to invest in digital platforms, and benefits from long-term demographic trends like the aging population. It's a large, complex business with strong cash flow and a shareholder-friendly capital return strategy, currently mispriced by a nervous market. At Insightful Value, we specialize in spotting these kinds of setups, where fundamentals and price are telling two very different stories. Our mission is to simplify the numbers, highlight what matters, and help you see past the noise. If you want more deep dives into companies like Elevance, head over to insightfulvalue.com. And if you haven't already, hit that subscribe button and like the video so we can keep bringing you sharp, data-driven insights.